Welcome to the Inner Circle Boardrooms Backstage Pass. This is the channel for professionals on the go interested in business, finance, and investing. My objective with this channel is to create content that informs and educates. I will be bringing you special guests like the one we have here today. Jamie Constable, founder and CEO of Rcapital, award-winning turnaround and growth investors, also an experienced investor and entrepreneur with a long track record of corporate restructuring and delivering high returns, particularly in distressed markets. If you enjoy this content, please don't forget to like, share, and subscribe. We'll be creating weekly boardroom conversations just like this. So let's crack on with our conversation today on smart investing. We know that every recession creates, or downturn creates, winners and losers, and this time won't be any different. So our objective for our conversation today is to understand how investors like Jamie are approaching the markets and to explore some of the gaps and opportunities. We'll also be talking about what is the key to a successful restructure and also looking at where it often goes wrong. So, Jamie, delighted to have you here today. For those of you not aware of Rcapital, just to provide a bit of context around these guys, they've done about 70 deals since 2004. They've sold and exited about 55. You've invested 35 million in the last 3 years, and your average investment is about £3 million. And your current portfolio is about 15 businesses with a combined turnover of about £300 million and about 2,000 employees.
Listen, thank you for inviting me on. You seem incredibly well informed, actually, perhaps more so than myself on some of those numbers. So well done.
Jamie, let's crack on with this conversation. You've done a lot of deals there. I'm really interested to just understand on some of your previous deals. What are the sort of average returns that you guys are getting on some of those investments?
Our average returns look very healthy when you sort of calculate cash returns. But I think the difference between our type of investing and typical PE investing is that we're very, very hands-on in the business. So we always take ownership and we drive through change in the business. So, it's really more like, an entrepreneur buying a business and then really creating value in that business. We're very hands-on. We work very closely with the existing management team. So, when we go into something, we're hoping that we'll, increase the profitability substantially. And, our returns can be, 5 to sort of 10 times what we invest. So, but at the same time, it's distress. So you often get ones where you don't hit those numbers because you realise that it's going to be a much more challenging turnaround than you originally thought, and you'll be down to sort of getting your money back and licking a few wounds. So there's a wide spread, but when we get them right, you get them really right. You can get them wrong, and you get a group in the middle that seem to do okay.
What was that one business that you made your first bet on and got a return?
It wasn't until 2004 that we officially set up as Rcapital. In 2001, there was a mini recession, but it was more of a sort of a dot-com collapse. So there wasn't really many good businesses to buy. But it was interesting because I came back into the market and I realized that whilst it had been absolutely hectic in 1991, 92, and it really quietened down, that in any market you get opportunities to buy distress. In a growth market, companies overtrade and they get into trouble. And in 2001, I sort of came back and started reconnecting with lots of the people I knew and realized that there was a good market there. And then in 2004, I finally persuaded a lovely gentleman, Stephen Murphy at Lloyds Bank, to sell me their debt. And the banks never used to sell debt, especially bilateral debt. And I did a deal with him where I just showed him what we could do, and I paid par for his debt. I took this away and restructured the business and explained the whole process to the bank and what we did. And that was a really good point for us because then it allowed us to buy debt from the other banks because we'd already done it with one bank. Yeah. So that was great. And really no one was buying debt at that point. And that's when we officially launched Rcapital, which, the magic name R was just because it was our money. It was no more complicated than that. So we called it Rcapital. And off we went. So we were trading before that, but that was our official launch date as such.
Talk about 2004. How did you fund that?
We had a little bit of our own money. Distressed companies by their very nature are not expensive. but they need a lot of work to turn around and create value. So we would use our own money where we could. If we didn't have any, we would like beg and borrow from friends and colleagues, and bring them into the deal and give them a bit of equity. Pay them an interest coupon. If you get a turnaround, if you do it well, you can get your money back, your initial investment, quite quickly, because you can refinance it out, and then your real return comes from the equity. And for some of our early deals, we were very lucky. They needed less money than we thought. We managed to refinance them quite quickly, and we also sold them off for equity in relatively short order. So that built up our cash reserves, really. And we just carried on like that, and we just kept reinvesting and reinvesting. And if it was a bit too big for us, we'd bring someone else in to help us. I had a lovely man who was ex-Arthur Andersen, Don Hanson, really clever guy in his 70s. He was very supportive, used to get involved in quite a few of our deals. And then we got to the point where we'd actually made enough that we didn't need anybody else. So that was a nice point to be, where we could just invest our own money. And it's been like that now for quite a few years. I did my partner Peter Ward, that we set up with originally in 2004. He retired in 2016. We had a very big win then, and he just says, I don't need to do this anymore. Thanks very much. I'm going to part myself up. And since then I built a younger team, really quality guys that have come out of the big four in the main. And the business has gone on, from strength to strength, really.
Just for those young investors out there, how much money do you need nowadays to be able to do something that you did back then?
Money is a really small part of what we do. So, you could buy a distressed company for £50,000. If you can find it, it might not be the right one, and you might lose your £50,000. You've got to. It's the skill of understanding insolvency. It's the skill of getting involved in the business. It's the skill of turning the business around. It's the skill of understanding the key things you need to do very quickly. It's the pace at which you do it. All those things are so key. And yes, you need money to open the door, but you just need enough money to make sure you've got control. There's no point investing in a distressed company if you haven't got control, because you won't be able to do all the things you want to do. But distressed companies go from very, very small to very, very large. So, you can do it with a relatively small amount of money, as long as you've got the time and ability to actually go and turn it around.
When you compare this crisis, what are some of the similarities and differences you see from some of the previous ones in your investment career?
This is like my third proper recession, I guess, the first one being the early 90s. In the early 90s, it was fascinating because there was no real help for businesses, and the consumer got absolutely slammed. Interest rates went up massively, 8%, 15, 16%. And that was a very different recession. And people just had to get on and deal with life. The recession 2008 was interesting because there was a huge amount of support from the government. Suddenly you could delay paying your VAT and your PAYE, and that helped a lot of businesses. But it also created quite a zombie culture where the banks just didn't want to take any action. The loans were left there, and it was very difficult for those businesses to then sort of do anything because they were saddled with debt. But no reason to pay the debt back. And there is an argument to say, look, if you have a hard cull, it's like survival of the fittest, isn't it? The companies that aren't good enough go, and the good ones survive. I think what's been hugely different here, the reason we've gone into recession is obviously different. It's affected the whole world. The government support has really been huge in this case. All the VAT and PAYE deferments, furloughing staff, that's been a huge help for businesses to survive, and the ability to take out loans. But of course, what that doesn't do is help you at the other end. And what most people forget is that going into a recession isn't as difficult as coming out of a recession for a business. Because when you go into a recession, you can defer payments. You're not paid your VAT, you're not paid your PAYE, you probably stretched your creditors. The bank here are giving support. So you get yourself through. But when we come out of a recession, and at some point, who knows when we will, those companies need working capital because their turnover starts to come back. And that's when you get more insolvencies than at any other time in a recession, is when you exit a recession. So we certainly haven't seen the worst of this yet. That time is still to come. I think this was really unusual because there was an anticipation at the beginning that maybe this is just a V. It's a one-off event. We can all understand it. We can come out the other side. I think, now we all appreciate it's going to be way more than a V. When's it going to get back to normal? Who knows? When will there be a vaccine? All these unknowns are out there. So actually buying a business at the moment is incredibly difficult. There's two simple rules when you buy a business. You need to understand what it's going to cost you on day one and what it's going to cost you to turn that business around. So at the moment, I don't understand exactly what it's going to cost me on day one, but I have no idea what it's going to cost me to turn it around. And especially in the retail sector, in the leisure sector, how do you work out what that business will cost you? Because you don't know when it's going to come back. So that at this point in the recession, it's very, very difficult to buy anything. Everything we've done so far has either come with a dowry or has got huge asset cover that we've been comfortable with. But those businesses that rely on consumer in particular are going to really struggle. And I think this recession also is going to see people come out at different times. I think, the airline industry and anyone supplying the airline industry, you think, well, this is going to be a really long recession for those. Will the fact that we're now having this call on Zoom really affect the whole market when it comes to business travel? People realize they don't need to travel as much anymore. So, that could take a long, long time to come back if it ever comes back to the heady days that it was at. But then you could argue that tourism travel might come back a lot quicker. So it's going to be different for every sort of sector, and other sectors have done incredibly well. Anyone that was selling online has had a boost. We bought a business called Feather and Black. We turned it into an online business. We actually bought it just before we intended to, before this crisis hit. And we intended to turn it into an online business, which we did, but we got the benefit that everyone started shopping online. So, that we had an advantage there. But it's very, very difficult, this one, because everyone's going to be affected differently. And I think the real shame here is you could have had a great business, and if you only have one business, that business might now be decimated. And you've done nothing wrong. You did all the right things, but that business is decimated. You could have another guy who's got a very ordinary business, and his business is thriving. And no one could have planned for that. I think that's a devastation about this recession. There has to be more redundancies. There's no reason why most businesses at the moment, they're not suddenly going to increase their sales and start recruiting people. It's quite the opposite. There's more pain to come. There has to be. So those issues have come. The other issue, which I think is a bit unfair on business. So the HMRC or the government has said you can defer PAY and VAT. What they haven't let everyone know is that on the 1st of December, the HMRC become a preferred creditor. So in any form of insolvency, they get their money before anyone else, unless they've got a fixed charge on an asset. So that's going to, again, that makes it really difficult for companies. So this unsecured creditor that they've built up is now going to be a preferred creditor in any form of restructuring. Again, it's going to make it very difficult for businesses in the future. It's some of the new insolvency laws that came in, I think, are actually going to make it difficult for the banks to lend. You now look at your floating charge assets and you wonder whether there's any security in floating charge assets with the ability for companies to go into moratorium. So there's some headwinds against businesses as well. And I think that's going to be the issue when their income starts to come back. Will they actually have the working capital they need to deliver those sales that are coming back into the business? And as I said before, that's where you're going to see more insolvencies at that point in time than you will at this point in the recession.
So do you anticipate that is likely to come in Q1, Q2 of 20?
I wish I knew. I have no idea. I have no idea at all. If we get a vaccine and suddenly everyone's got it on the 1st of January, it'll probably come back quite quickly. If we haven't, it could be a long time. But I wouldn't like to pretend that I have any idea when that might be.
So what sort of impact does a global pandemic like this have on investors like yourself? And, how is it actually impacting revenues? Because ultimately, you said earlier that you guys operate slightly different to other PE firms. You use your own capital as well. So if you can just give us some insights around sort of how you're navigating through it and what sort of impact you're seeing.
Well, I mean, you got to remember, so we've got a portfolio of 16 businesses. So as soon as this sort of hit, we used to turn around, we used to distress. So we went to every portfolio company and we went hard and fast and just said, right, just assume the absolute worst. Assume no one's going to pay you. Assume you've got no income coming in at all. And you've got to find a way of being cash neutral through this crisis. So you start at that point, and then you build the budgets back. So, a couple of our businesses haven't been affected, and they could see they weren't going to be affected with some of their income lines, but they would be affected with other income lines. And therefore, straight away, we had to make cuts in the costs that we have and the overheads we have. And what we've found is that out of our 16 companies, one we had to close. They were in the airline industry, and the order book just disappeared. So you were funding nothing really. And the other, we had a business in the trampoline parks, and we just sold our German division to a group over there who had expressed an interest in our UK division, and we were very fortunate in that they bought that, and they also paid a nice price for it. So they were, that could have been a casualty otherwise. So we were quite fortunate. We've had minimal casualties, but all of the businesses are performing, I would say, less well. There's a few exceptions, but they're performing better than the budgets that we put together, assuming this crisis. So that, from a mental point of view, is quite an interesting thing, because if you put together a forecast and you never perform it, you always feel a bit low and a bit down. I'm never going to hit this. But if you actually make your forecast so that you can at least achieve it or overachieve it, it does give you, a bit of positivity. So, well, actually, we're not doing too badly through this. Look, but the forecast was much lower, but at least we're beating the forecast. So that's the first thing we had to do, was really get on top of all our portfolio companies and understand how we can make sure that they survive, and they survive well through this. And it's been a fascinating experience. Two of them now do not have an office. They don't feel the need for an office. So there's been some great cost savings throughout. Lots of them had to shrink their staff because the business just wasn't as much. But we've made all those decisions, and the businesses have remained profitable, which is great. So that was sorting out our portfolio. And then, of course, you're inundated with opportunities. Because it's what we do, and therefore, anything that gets into trouble, it seems to come across our desk. But, we have this simple investment criteria. We need to understand what it costs day one and what it's going to cost to fix the problem. And most of what we saw in the early days were consumer-facing businesses. They were restaurants, pubs, leisure, retail. And we don't understand when the business is going to come back. So we can't invest in those. So we didn't do any of those deals. There will come a time when it's right to do those deals, but at the moment the time isn't right. But the sort of transaction we've been looking at is where we've done a few deals with large corporates. They've got a loss-making division. They'd like to sell it as quickly as possible. They actually pay us money as a dowry to take it away because it's cheaper than shutting it down. And with those, we can use our expertise and our skill to really reduce the cost and make those businesses profitable. And we've done a couple of turnarounds basically in this market, where we've actually turned the business around, and it's been easier to do in this market than normal because you haven't got day-to-day business happening at such a rate. So we've been able to go in and understand the business very quickly, understand the market very quickly, understand who the clients that will carry on and will pay us, and right-size the business so it reflects that. So we've had a couple of very successful turnarounds in this market, which I wasn't expecting. We're quite surprised at, but that's been good. But at this point in time, you just got to be very, very careful about what you buy, because you can't see, or you can't work out the income line for a business. If you can, that's great. But if you can't, it's very difficult to buy anything, especially distressed.
Leading on to the next point, and you've touched on this a little bit already, but how has your investment strategy changed as a consequence of the lockdown during and post?
It hasn't really changed because we've always had the same investment. So what we're looking for great companies that have got themselves into trouble. And we look at 90 to 100 opportunities a month. Historically, we've done 5 or 6 a year. So we're incredibly fussy and trying to find those opportunities. When we find those opportunities, you still need to understand how much money you put in on day one and how much money you need to turn the business around, because you can work out what it's going to be worth once you've turned it around, but you need to understand how much money you're going to put in, because it's not just what you pay for it, it's the cash that goes in. So that number is your buy price. And if your sell price isn't high enough at the end of it, it's not worth doing. And I looked at one yesterday, and it just didn't make sense. There was a small return, but with all the risk that's going on, when you got into the detail of it, the liabilities were just that you were going to have to inherit were too great. So we've always had that discipline. So it hasn't really changed. It's just you're slightly more wary because the only thing that's changing is you need to decide, will the market come back to what it was before? So when I'm looking at my my ultimate exit price, if I'm buying, I don't know, a business airline, will it ever go back to the values it used to have? Or will that never happen? And therefore, I can't understand the value, and therefore it's very hard for me to understand what I can pay for this business because I can't understand the value, even if I could work out what it was going to cost me in the middle. So I guess exit valuations are the thing that perhaps are changing our view on some deals that we might have done before because we were more confident about the exit value, and now we might be less confident.
It's a really interesting point you've spoken about there is exit values and how do you evaluate that business when you can't clearly forecast what the future is going to look like. What are some of the conversations you're having with some of your investment portfolios right now? What are some of the good, bad and ugly?
Well, I mean, the good is that they're running well, and we're looking at opportunities where we can buy other businesses that will boost them. We've got a couple of businesses in the facilities management sector, and they both seem to be doing well. I think they just luckily had the right clients.
Yeah. So are you looking at sort of bolt-ons to your existing portfolios, supplementary to their existing portfolio, and then bundle it up and then sell that on? Is that something that you guys?
It's an obvious thing to do, isn't it? If you've got a well-run business in the sector, and there's other businesses out there that might now be a lot more stressed than they were before. The pricing is now realistic. You can buy that as a trade buyer and merge it with the one you've got, and you pick up the customers and the clients and some infrastructure costs and off you go. So in any market like this, there's always a great opportunity to do that as long as you've got that one business that is a good business.
The interest rates are low at the moment. Valuation, the stock market is very high. Businesses, when you look at them, like let's say the argument is, are they still valued quite high, or is there some depreciation there? I obviously appreciate it depends on the sector that you're going into, but some of those businesses, the valuations haven't actually dropped. Is that sort of what you're seeing as well with some sectors?
I think the public market and the private market are two very different places, aren't they? I mean, the private market price is driven by either the owner and what he thinks the value is, or the fact that he's now distressed, and if he doesn't sell it, he can't pay the wages at the end of the month. They're the ones we prefer because obviously that's not so price sensitive. So that's in this market, that's what you're going to be coming across. That's what you're looking at. Businesses that are just carrying too much debt and can't survive. They're the ones that you want to be buying to add to your existing portfolio to create your buy and build. If the guy's sitting there and he's long on cash, he's got a great business, he's going to have a high price expectation, which is in this market going to be difficult to justify.
So you're in that marketplace where you are looking at distressed markets. What can you typically expect in terms of distressed and below market value?
It doesn't really work like that. So how do you value a private business? You sort of take the EBITDA and you times it by a number that seems the right number, and it depends on its growth and how well it's doing. And is that number 4 times? Is it 10 times? Is it 50 times? But if the business is loss making, that all goes out the window, doesn't it? So so the discounts are massive potentially because the business isn't what it was before. If the business is still making a strong EBITDA, why wouldn't it be the same value? But it's not distressed. But the ones that are distressed are the ones where actually they've run out of money, and there is no EBITDA. The EBITDA is now probably negative or very, very small. And the driver isn't that we want to sell this because we like to sell this. The driver is we have to sell this because either the bank have pulled in the facility, or we've run out of cash and we can't pay the wages at the end of the month. Therefore, the price is sort of slightly secondary to can you get there quickly enough and make sure there's enough money to pay the wages. That's still a cost of acquisition to us because we've got to put the money in to pay the wages. But going back to my earlier point, it's working out what am I paying plus what is the cost to turn the business round. So, distressed companies have a totally different valuation. It's not saying, the valuations come off 10%, 20%. They're not distressed companies. That just means there's less buyers out there. Distressed companies normally go from being valued, 100 million to it's 2 million. But it's 2 million because it's not worth anything like 100 million now because the business is now loss making. It was profitable before.
What are the sectors that most and least impress you from some of your portfolios and when you look at the marketplace at the moment?
Least impress me. One of the tough sectors to buy in at the moment is anything consumer facing, anything leisure, because no one knows when it's coming back. Would you buy bowling alleys today? Probably not. Would you buy a pub chain today? Depends. Some pubs seem to be doing quite well, but you still think, what if we suddenly get locked down and the pubs have got no income for 3 months? Would you buy a retailer today? that's just on the high street. If you thought you could turn it into an online retailer, maybe, but if you've got a massive estate on the high street, you've got to be thinking twice about that. With all these industries, you don't know when it's coming back. And you don't know in some situations what it's going to look like when it comes back. It's not a simple calculation of, well, we used to sell 50 grand a month, we'll sell 50 grand a month going forward. Well, will you sell 50 grand a month going forward? Because have people changed? You know, the older generation are now buying their food online because they had to, and thinking, actually, this works really well, doesn't it? Why did I used to go shopping on my big purse and everything else I could hardly carry? I can buy it online and get it delivered. So you need to understand what it's going to look like. So it's I think those sectors are so difficult to buy at the moment, you know, even for a distressed investor. And it's a bit like, you know, we when the oil price collapsed last time, we looked lots of oil businesses, but they're all based on the oil price coming back. But what if it never comes back? Then what have you bought? And you know, and it's the same here. You know, someone's view might be that retail is going to come back in January. Someone else's view might be retail is going to come back in June. No one knows. So make an investment decision based on assumptions such as that is very difficult. So I think they're probably the toughest ones.
Which business models will not survive, and what do you think will be replaced by them?
I don't know, because I don't really know what the world's going to look like when we come back. You know, what will people's attitude be? You know, after 9/11, everyone said no one would fly again. 6 months later, everyone was flying again. So do we go back to more or less a norm? You know, does a vaccine come and everyone feels happy and looks back and think, what was that all about? And then sort of it's all back to normal, isn't it? Or, you know, is this a game changer? It feels that technology that was changing has just happened quicker than it would have happened. So what might have been 10 years for people to do a lot more shopping online has happened in a year. So I think, you know, the high street's gonna suffer. It was suffering anyway, and this is just, you know, really being the sort of final nail in the coffin. There was too many restaurants before, so there's going to be a lot less restaurants going forward. You would expect. I think there was lots of industries that, you know, just had overgrown themselves anyway. There was just too many out there, so that, you know, this always has an impact on that. But yeah, any recession creates innovation, and I think you'll see quite a lot of innovation in food. You know, people have learned to sort of dial up and get their food delivered quite quickly. I think you'll see an explosion in the quality of that. You know, some of the quality is a bit substandard and the packaging is not great. You know, packaging businesses at the moment are doing really well. And I think you'll see innovation in that. You'll see innovation in how you order food, how food gets delivered, the quality of the food. Yeah, I think that it's so, you know, no one knows what it's going to look like. And I think if anyone tells you what they think it's going to look like, it's their opinion, isn't it? It's not really based on any facts, which is always very difficult.
Where are you seeing distressed opportunities that you think will recover?
There's certain sectors, you know, that they're going to have to carry on. FM is a good example. You know, the FM business will carry on. It depends what FM's focus was. You know, one of our businesses focused very much on hospitals, police, ambulance. You know, that's not going to change. If your FM business focused very much on the retail sector, it might be a bit tougher. So it's very difficult to, you know, we've spoken about a few sectors we think might struggle going forward because there could be sort of seismic change in what they do. But I think in general, businesses will survive in sectors. It just depends how many will survive in a sector. They won't all survive. But, you know, again, it'll be the strongest survive and the better ones survive, and the better ones probably will benefit from this and the weaker ones won't benefit from this. But, you know, most sectors have good and bad within them.
We've spoken a lot about turnarounds and restructuring. And what is the key to a successful restructure program? Is it all cost, or is it more to it?
I think a lot of businesses we look at are overburdened with cost, and there's a lot of naivety we find about people think their sales are going to increase. You know, that 9 times out of 10, that's not the case. The sales decrease, but they've really made that decision because they didn't want to reduce their cost. So reducing cost is much more important to us when we go in. It's very easy to put your overhead back in a business, much easier than trying to increase your turnover. So we're always a great believer in you shrink the business more than you think, and then you sort of covered yourself. And if it's better than you think, you put a bit of overhead back in it. But I think the big key is the speed of which you move. These companies, every day counts. The quicker you can make these adjustments, the more goes to the bottom line. And I think from our point of view, having control is always absolutely key, because if you have got to make decisions by committees and boards, and Margaret's worked for Johnny for 30 years and he doesn't want to get rid of Margaret because he knows her family. It just doesn't happen. You just got to get in there very quickly and make things happen. That's the key is speed. And once you get the momentum going, you get everyone focused. It's amazing what changes you can make.
Yeah. And what are some of those common business failings that you see that makes those businesses not investable?
Well, one of the common reasons they get themselves in trouble in the first place, it's a classic scenario. If you've got a successful business that's doing really well, you normally end up going off and setting up another division to do something else, and another division to do something else, another division to do something else. Of course, we only see a very small percentage of those, but the ones we see is the original business is fine, but all the other divisions haven't worked. Which is a relatively easy restructure. You just get rid of all those divisions and go back to the original one. But that's always, we find that it's interesting. The person that's running that business and built that business is not something he wants to do because he's created it.
Yeah.
So that's a classic business failing, really. Over trading is another classic business failing, which we're going to see hugely when we come out of this recession, which is basically never been capitalized properly, which is no fault of the owner, because the owner is obviously often the entrepreneur. He set it up on a shoestring through pure energy and enthusiasm. He's built it up well, but never really had, the excess cash to perhaps, put an MD in place and an FD in place. So he perhaps does everything himself, relies on a good bookkeeper. And often you see the guy, he was an amazing plumber, architect, but he ends up running a company. But he's not actually good at running a company. He's good at being an architect. But because it was his company, he sort of defaults to running the company. And then something goes wrong within the company, and suddenly it hasn't got enough cash resources, and it falls over. And we see that a lot. We see sort of shareholder disputes. You often get director disputes where you've got a good company, but they all sort of fall out for various different reasons. But they're in the minority, I'd say. It's normally companies just expanding into different divisions, different things, or just undercapitalized and growth issues, really, where they just haven't got the cash to keep up with the growth.
And what's the key to a successful relationship working with investors like yourself?
So it's interesting that because we are from a business background, we're very entrepreneurial. So we're so empathetic with the business owner. You go into a meeting with a business owner, and this guy might have been working in this business for 20 years. He's built this business up. It's been incredibly successful. He's very well known in the local town, and he's about to lose everything. And that is that's a really painful experience for that person. And we know what that feels like. So we're incredibly empathetic with them and try and we're there to work with them to find a solution to stop it just ending, and is a way forward. And I think you create a very strong bond and relationship with that individual when you go through that process. And open communication is everything. We're great believers in that. We don't like people that just tell us the good news. We want to know the bad news, and we encourage bad news. And no one ever gets blamed for telling you bad news. And I think that's so key, that people can tell you things they're worried about, tell you things that have gone wrong without the fear that someone's going to shout them down or say this is ridiculous. Why weren't you on top of this? You let people have that environment where people can talk about issues, and therefore you can deal with them. There's nothing worse than someone having a massive issue not telling you. You find out 6 months later, and by then it's too late. So we encourage that open communication. I think the key to us is having open communication with people in these businesses, from them to us and us to them. But we're very involved in the business, so that sort of comes as slightly natural. Where some other PE houses might be slightly more hands off with just one representative on the board. We're much more hands on.
I'm conscious of time, and I want to get a few more questions in, slightly different. Take a different angle on these ones. But what are your personal views around sort of how the government is responding to the crisis?
Such a difficult thing for any government to deal with. You're dealing with an unknown, and you're trying, on one hand, you're trying to balance the economy and keep that running. The other hand, you're trying to stop people dying. I mean, you just wouldn't want that job. It's so difficult. They will never make everyone happy, and unfortunately, they'll probably make everyone unhappy because they can't please one sector because that would just upset the other. So it's always a balance, isn't it? And it's very. I can't criticize them because I don't know how anyone could do it any better. It's everyone will have they criticize. Well, they should have done this better. Should have done that better. Should have done this better. But really, something that no one expected. It's easy to say you should have acted quicker, but actually acting quicker might have been more detrimental to the economy. In hindsight, you could, it was easy to say, oh look, look, France and Italy have had less deaths, but now, we're behind the curve on them. But is that right? Is that wrong? No one knows, do they? It's just totally. No one could be prepared for this, and I don't have any criticism at all because I just think it's a very, very difficult situation that the whole country's in.
And how do you make sense of global macroeconomics on the basis of when you think of US elections, when you think of China, when you think of Brexit, trade wars?
We try, I mean, it probably sounds a bit contrite, but we sort of, to some extent, ignore the macro situation because we can't change it. It is what it is. So we look at the micro, we look at the business, we look at the sector, we look at the industry. If there's some obvious macro issues that are going to affect it, of course you take those into account, but I think you could spend so much time trying to work out where it's going that you never make an investment decision. When we buy our business, we're very focused on downside risk. We want to know how we can trade our way out of a situation if it doesn't go the right way. If something dramatic happens in the macro world that will mean that this business is no longer viable, we should be able to trade ourselves out because we looked at the downside risk. But we don't really spend a lot of time analysing the macro environment when we're buying these businesses.
What do you think will happen to financial services in London post Brexit?
So, as an optimist, I think London is a fantastic place to do business. We're very fortunate that we've got where our timeline is between America and Asia. I see so many wealthy individuals and families coming to London.
Yeah.
Because the way London, its legal system, because it is, the financial system, the ability to raise money, etc. I'd like to think it's going to be a positive, not a negative. I think there'll be some short-term pain, but if I was to think 10, 15 years ahead, to me, we can very much be similar to, not too dissimilar to Singapore, as a real financial hub of the world. I don't think we need to be part of Europe to achieve that.
Lastly, my question is around interest rates. Obviously, we've seen that interest rates have been low. Do you anticipate these interest rates will raise in 2021?
I can't see it. I mean, the economy is not suddenly going to get better, is it? And we want to raise interest rates. What's in a way ideal for the government is we get high inflation to erode the debt that we've all taken on. I mean, I guess one of the advantages about low interest rates is the debt that this is costing the country is relatively cheap to repay because the interest rates are so cheap. The whole thought of negative interest rates, I think, is fascinating. Could the government raise bonds based on negative interest rates? So there's no real cost, and actually, your debt will then erode with even low inflation. But no, I can't see interest rates going up anytime soon. Really.
So do you anticipate 2-3 years out, just out of interest?
I think it could be longer than that. They haven't gone up since the last recession, have they?
Yeah.
So, you need the economy to be really rock and rolling to get interest rates up. And when's that going to happen? If you look at the other economies that had issues before us, you look at Japan, really what we're only doing what Japan started doing, much earlier than us. So I'm not sure we're ever going to see them back to where they used to be.
Jamie, I've thoroughly enjoyed having you here. I'm sure our listeners have too. Now, if they want to get in contact with you and reach out to you, what's the best way forward?
We've got a website, Rcapital, R in the letter, capital the word. We're all on there. Feel free to make contact. That's probably the best way, or the phone number's on there if they'd like to call us. Yeah.
Fabulous. Well, I'll include that in the link below. Guys, I hope you enjoyed this conversation with Jamie and I. It's been very insightful to know how Jamie's navigating through some of this and what his views are on the markets at the moment. Please don't forget to like, share and subscribe, and we will see you on our next video. Thank you, Jamie.
Thank you. Yeah, nice to be invited. So thank you very much.